I'm going to give everybody just 1 minute because I think we've got a problem with the channel and then to switch YouTube channels. I can see people switching over now. So we start in just a second. I'm going to give everybody just 1 minute because I think we've got a problem with the channel. Okay, let's get going. So busy morning. We've got a news as normal from me, and then we're going to be talking to three leading income managers. So Thomas Moore from abrdn Equity Income, David Moss from CT UK High Income, and Ben Green from Supermarket Income REIT. And then at 12 o'clock just thereafter, I'm going to be announcing the winners of our Quoted Data Investors' Choice Awards. So news first, a couple of battery funds in Caledonia, should be quick. Howany Energy Income first. So not a very big fund, not very old fund, went wrong quite quickly, all kind of linked initially to rising interest rates, but also to a problem that the batteries funds had in terms of earning money from the national grid. Went out to a very big discount, and then they've been saying they've been trying to do something about their discount since, and they've decided to try and sell the fund. So in what they announced this morning was that they've written down the NAV from 94, almost 95p down to about 85, 88 and a half. And that mostly that's down to them increasing the rate that they discount their full forecast cash flows at by 25 basis points, so it's 0.25%. But they've also lowered their revenue assumptions as well. So that all drags the NAV down. They are now fully operational. So they had this portfolio of things under construction. All these things are now being energized. And they do seem to be doing reasonably well in terms of revenue. So about getting off £68,000 a megawatt a year, so annualized, based on what they're earning in November. Obviously, this is very seasonal. It depends when the wind's blowing, the sun's shining, all that sort of thing. But that's not too bad, actually, if they can sustain that, but that's probably not sustainable. Anyway, they are still trying to sell the portfolio. They're quite a long way down the line with this. They've got a short list of bidders that are doing detailed due diligence. The whole thing's been pushed back by about a month, but they do expect to be able to announce a bid in December and to sign in January 2025. Now, that's all quite encouraging, really, especially when you think this thing's still on a 40% discount. So that's a 40% discount to the written down NAV based on today's share price. Now, whether they'll get NAV for it or not, I don't know, but it does feel to me like the share price might be a bit too low at the moment. Gresham House, bit more advanced along the way, has had the operational batteries for much longer, trading at a much wider discount, 54%. No dividend because of obviously for no income or not enough income to pay a dividend. So what they want to do is to try and prove that their NAV is about right by selling some stuff. So they are looking to sell an equity stake in a 50 megawatt battery project that they've got called Glastonbury, and at the same time raise a bit of more money that they can use to upgrade that project to 4-hour batteries, and also take some of that cash and reduce their debt pile. Now, the debt's not enormous, so they're saying that's going to peak at about 20% of gross asset value, so that's normal gearing of about 25%, but they are looking to refinance it. And I think the issue is that the lenders are looking at the projected revenue and saying, can we really rely on that to pay the interest and get our money back? And so therefore they're thinking we need quite a lot of coverage on this before, a lot of headroom before we'll lend you the money. Once they have refinanced the debt, though, they will reinstate dividends, and that's obviously going to be very good news for shareholders. So what they're leaning towards is paying what it says a sustainable dividend, so fully covered, of 3 small interims and then a larger final. And they've kind of hinted towards, I think, about 4p to 6p. So it was 7p a year, and they were hoping to grow that. But if they want it to be fully covered, they want to be covered by cash flow. They're saying cash flow per share is going to be about sort of 4.5p up to about 6.2p next year. It's about 45 million of EBITDA up to about 55 million. They can be fairly sure about getting that because they've already got a big chunk of it contracted. Remember, they did that deal. And then they want to grow the earnings beyond that. So there are things that they're saying this morning that they can do, that they think they can grow the income really quite substantially. Now, the interesting thing here, I thought, was that they're assuming that they're only going to get, on average, about £45,000 per year per megawatt, which is a long way short of that 67,800 that Harmony are earning. So again, it feels to me like we are near the bottom of this one, but it's not as sort of certain an outcome as it would be if Harmony selling the portfolio. Finally, Caledonia, another one on a big discount, completely unjustified in this case. The family, the Kaysers that founded the trust at the beginning, their percentage ownership has been creeping up. And from the takeover co point of view, they form a concert party. So they own 49.49% of the voting rights of the shares now. And when you get over 30%, you can trigger a mandatory bid if you increase your stake. And the only way you can avoid doing that is to get permission from shareholders to say, if I up my stake, then I don't have to make a bid. And that's called a Rule 9 waiver. So they do this every year. They vote it on in the AGM, and it just lets the stake creep up and up and up and up towards 49.9, but it can't go through 49.9. So what they're having to do, because they're almost at that limit now, is convene a special meeting to ask the independent shareholders to approve buybacks for the sake of the concert party through 50% without triggering a bid. I think that's quite a straightforward thing, really. I can't imagine that people would be opposed to doing that. They do need to do buybacks to help control the discount a bit. They're asking permission to buy back up to 5% of the share capital. They bought quite a lot of shares back over the last 6 months. And so they just want to carry on doing that. The concert party won't vote on this because obviously they're completely conflicted. But I would be surprised if the independent shareholders didn't say yes. And if you are a shareholder, please do vote. So that is enough from me. We will now talk to our panelists, who you should be able to see on your screen. So good morning, everybody. Thank you very much indeed for doing this. What I'll ask you to do first is just sort of introduce yourselves. So we'll go, your screen doesn't look the same as mine, but we'll start with Ben because he's next to me in the corner, please.
Good morning, James. Thank you. So I'm Ben Green. I'm from Atrato Capital, which is the investment advisor to Supermarket Income REIT. Supermarket Income REIT is a FTSE 250 listed net REIT real estate stock, and we invest in supermarkets which generate long, predictable income from very high quality tenants like Tesco, Sainsbury's, and more recently Carrefour in France.
Thank you. And Tom.
Hi, James. Yes, Thomas Moore, Aberdeen Equity Income Trust. I've been managing the trust since 2011. I've been at this organisation since 2002, started in the industry in 1998. I've been doing UK equities for virtually that entire period, so quite a few stories to tell over those years.
Thank you. And David, finally.
Yeah, thanks, James. Good morning, everyone. David Moss from Cumberland Threadneedle. I run the CT UK High Income Trust. I took this over actually in July of 2023, so relatively recent on this. I've been in the organisation since 1996, so those 6 different brand names. So I won't go for them all, but I'm pleased to be here today to talk about income.
Thank you. So we are talking about income, and again, we'll go around the same way, I think. So start with Ben first. So each of these funds actually generates quite a decent yield, I think. So could you just explain just for supermarket income REIT how it achieves the yields that it pays out, please?
Yeah, absolutely. So, so supermarket income REIT owns supermarket assets, so properties, so the actual supermarkets that you go and visit. It buys those at initial yields of between, say, 5 and 8%, and then typically those are on leases where there's an inflation uplift every year or every 5 years. Those leases are paid by Tesco, Sainsbury's, Carrefour. We have some leverage in the structure. So in real estate terms, we think of that as a loan to value. So roughly 40% of the capital structure is debt and 60% equity. And at the current share price, that's generating a dividend yield of about 8.5%. We've grown the dividend every year since the IPO. More recently, we've been a little bit cautious around that because of increasing interest rate costs on our debt. But the goal is to deliver, progressive dividend over the long term from that growing income from the supermarket operators paying to occupy the supermarkets where everybody shops.
Brilliant, thank you. And Tom?
Yes, so Aberdeen Equity Income Trust has a 24-year track record of dividend growth. That's been achieved through some pretty volatile macro conditions. So we've obviously most recently seen a lot of dividends being switched off during COVID. So that was a challenge, but we overcame that, and we've covered the dividend for the last 3 years as well. So just had our year end at September, and the yield at the moment is 7%. How do we do that? Well, we've got an investment approach which fits that high yield anyway. So we're looking for companies that may not be in vogue at the moment, but we believe they have the potential to see their valuations re-rate. So typically quite a high free cash flow yield, quite a high earnings yield, the inverse of the PE. And therefore, they've got the capacity to be able to pay out lots of that cash in the form of dividends, as well as doing buybacks, and also investing in their business. So we've also got gearing. So the latest, we publish that every week. The latest RNS was 12% gearing. So that just helps at the margin as well.
Brilliant, thank you. And then David, lastly, and I think there's a wrinkle here because City UK has got a slightly different structure to the other funds.
Yes, perhaps I'll get to that in a minute. In terms of the basics of the fund, it's very similar to Thomas. It's a UK high income fund, so it does what it says on the tin. We have a diversified portfolio of UK stocks, so we have about 40 holders. We have 40 holders at the moment, including Supermarket Income REIT actually. So anyway, which we're big fans of, and we aim to deliver the level of income that we need in order to provide a growing dividend to shareholders, and that's important. It's a high level of income now. I think we're at 6.4 at the moment. Our half-year report was published today. The RNS is there if anyone really wants to read it. But we want that dividend to grow over time as well. We want our shareholders to be able to say, well, I've got a good level of income now, and I know that will grow into the future. Again, we managed that, although we were uncovered for a small period during COVID. Because the beauty of the investment trust vehicles, you can play that reserve if you need to. And again, I think we're about 20 years of growing dividends. So very similar. We think actually the beauty of investing in a UK income fund is that we can buy actually really good businesses that will grow their dividends. And we're not buying them because they're not very good, which is often the case. High yield, the market perceives to be a business that's in trouble or something. We think the UK market particularly is so attractively valued. Actually, you can buy really good businesses. They might be out of favour because of interest rates, because of the sector they're in, whatever it may be. But they have high yields now and can grow into the future. In terms of our structure, we have 2 classes of shares. We did have 3, which made it more complicated. We're back down to 2 now, which is ordinaries and Bs. And that means we can pay a higher yield than the underlying portfolio. So all of the income we generate goes to the A shares, the ordinaries, and that pays to them. And then the B shares have the same dividend, but it's paid out of capital. So it may help some shareholders from a tax perspective because it's a capital repayment and income repayment. But it means that overall the portfolio is about 6.4, but the running yield of the portfolio is somewhat less than that.
Brilliant, thank you. Just to the 2 UK equity income managers now, would you ever buy a stock that didn't have a yield, given what you're trying to do?
Should I go first?
Yeah.
Finished. Yes. it's obviously harder. I mean, I think if you were to buy a stock that, I mean, the classic thing would be an IPO where there's no income available at that point in time because it had declared it, but you expect it to. But yes, we would buy one because for us, it's about what the portfolio delivers overall. And we also we obviously have an aim to deliver capital growth. So if we can think, actually, we have a business here, but for whatever reason, there's no dividend at the moment, but we see potential for high capital growth. And in the context of the portfolio, we can still deliver that yield for our shareholders, then yes, we would. I would say probably unlikely, although we do have a range of dividend paying companies at the moment.
Yeah, and I would add to that, James, similar in the sense that the hurdle for a company that's not paying a dividend is very, very high in terms of your conviction that the capital growth needs to be sufficient to justify holding that stock in the portfolio. I mean, I'm running 50 stocks in the portfolio, so bang on 50 at the moment. You know, and I have got some lower yielding stocks. But again, you know, I see that as very much, look, I need to achieve total return. I want to achieve dividend growth. If I can own some lower yielding stocks that can help me achieve the dividend growth element, and therefore hopefully some NAV growth as well in a typical year, well, that's all to the good. But actually, the key 7% covered dividend is the key to, I think, our shareholders.
Fair enough, that makes sense. I think for all three of you, it's relevant to ask, how important is it to diversify the source of income? So let's start with Ben, please.
Yes, I guess we've probably got the least diversified source of income out of the three of us here on the call, because we've got the majority of the cash flow coming from Tesco's and Sainsbury's. So we're very comfortable with that because both of those entities are, you know, extremely large companies, and they're investment grade rated. So it means that, you know, the probability of them defaulting is very low. And actually, we mentioned COVID earlier on. You know, that they actually paid early during COVID because they were one of the net beneficiaries of the whole of COVID. We are keen to continue to diversify though, which is one of the reasons why we've made a move into France. But what we don't want to do is dilute the quality of that income. So our first deal was with Carrefour, who have a very similar kind of position in France as Sainsbury's have in the UK in terms of market share. They're investment grade rated, and also the quality of the actual underlying properties. So the properties actually look very similar and operate in a very similar way to our UK properties. So we would like to diversify further, but we're very conscious that although we're concentrated, we're very high quality at the moment. We don't want to dilute that quality.
Makes sense. Thank you. David?
I mean, yes would be the obvious answer. I think when I took this fund over, 30% of the income came from tobacco, for example. Now, while tobacco is a high yielder and Imperial particularly performing incredibly well, one can have lots of questions about the ultimate durability of that income stream. Additionally, I think BAT certainly at the time was having a few problems from an investment point of view. So yes, I think it is important to diversify. We have another sort of slight rinky-dink here in that we're allowed to have up to 10% of the portfolio outside of the UK. It's something the board in particular are very keen on. Actually, that doesn't really diversify income very much because I think it's pretty hard to find a higher income outside the UK. But it does enable us to do something different. And we restrict ourselves really to businesses where we feel they have attributes or qualities perhaps we can't access in the UK. But again, it's another way of the potential diversification. So I think it's very important.
And James, I would summarize my diversification across a number of different layers. So starting with the market cap allocation, I invest all the way down to companies of around about 100 million. So right the way down into the small cap part of the market. In terms of the index in the UK, last time I checked, there were 581 companies in the FTSE All Share. And then you've got names which are also listed on the London Exchange, which aren't in any indices. And one example of that would be BHP, for example, which has obviously got its primary listing now in Australia. So we keep our eye on a range of stocks. We've got a strong small cap team as well. So we're able to leverage that. So we've got about 50% large caps and then 50% mid, small and non-listed, non-index, I should say. So that's the first point. And actually, when you look at, if you do a scatter diagram of where the yield's coming from, there's no sort of R squared there. There's no sort of correlation between market cap and yield. You can find high yields all the way down to the small caps, all the way up to the mega caps. So I think that's the first point. Second point on geography, we are 43% UK and 57% non-UK. So that's not as much international as the index, for example. The index is more like 75 international, 25 UK. So if you invest in small and mid, you're likely to have a bigger weighting in the UK. But we think that's a pretty good diversification across UK versus other. And then in cross sectors, where we've got conviction, we really back that conviction. We've actually been going the other direction on tobacco in the last couple of years. So I've made tobacco a big part of the portfolio. So both stocks are in the top 10. They're both seeing fantastic operational improvement at the moment. So they're stocks which are just priced for Armageddon. Things are actually turning out a lot better than that. And so we're getting some really good total return from those stocks. So that's just under 10% of the portfolio. We've got lots in financials where we see lots of opportunities. We've got lots in energy, materials, and then the rest in consumer and industrial. So pretty diversified, yeah.
And then just to clarify, when you were saying the sort of 57-43, that's in terms of where the revenue or the profits of these companies are coming from, rather than where they're listed.
Correct. Yeah, that's revenues. So each company in their annual report publishes percentage of revenues, and that when you aggregate that, you get the total there.
To the extent that the three of you do invest abroad, are you looking to try and control the exchange rate risk, or is that something that just comes with the territory?
For us, it's relatively straightforward because Supermarket Income REIT has an investment grade rating in its own right, so it's BBB+ rated, which means that it can issue long-term debt. And so the way we've controlled the exchange rate risk to date on our CAR4 investment is to sort of match fund those investments. So we issued a 7-year bond, which basically funded the whole of the acquisition. So for the next 7 years, we're almost 100% hedged on our asset and income for the French assets. And I think that's how we sort of for the foreseeable future how we deal with that.
Fair enough. David?
It's something that we're clearly aware of, but not something we actively look to hedge. Partly, I mean, the European exposure to the moment is pretty small. It's about 3% of the amount of value in the UK is so high. Those bits, if you use the example, one stock we own, which is SAP, very low dividend payer actually to our earlier point, but a great source of capital growth for us. What am I hedging? Am I hedging the euro? Am I hedging the exposed to the dollar primarily? These are very diversified companies. And frankly, if you think about the dollar exposure in UK listed businesses, if we were thinking about it like that, we need to hedge all that as well. So it's something to be aware of. It's another reason why non-UK listed businesses will only ever be a relatively small part of the portfolio, but it's about being aware of it rather than doing anything actively about it.
Yeah, and so James, yeah, similar in the sense that it's not the primary driver of asset allocation. At the margin, we will have a look at the sensitivities of the portfolio in terms of our risk to make sure. I mean, we've got a risk management team that sort of basically provides each month, here are your key macro variables. And yeah, from time to time, the exchange rate will pop into the sort of top 5, top 10 variables, and then you have a think about that. I mean, in terms of directional at the moment, it's obviously the UK is going through a rough time in terms of PR, the news flow, the politics. It hasn't been great for a while, and it hasn't really improved this year post the election. But obviously, you're reading stories even this week about France, about the bond yield spread widening. So the euro's under a bit of pressure. Donald Trump coming in next year. So we're keeping an eye on all that. But at the moment, was a headwind. I should say, actually, it was a headwind in the last 12 months. Because obviously, if you're paying dividends in pounds, which we do, obviously in pence per share, and you're generating quite a few dividends in dollars, euros, etc. And the pound was actually surprisingly strong in the last 12 months. That was a headwind.
Yeah, fair enough. Now, one of the things that we've seen in the sector is like an increase in the number of funds paying income out of capital. and none of you are looking to do that. So I think I just wanted to get your viewpoint on why you think it's important to generate the revenue to pay the dividends. Maybe we'll start with Ben again.
Yeah, I mean, I think because we've got that very predictable income, both because we've got long contracts from very strong counterparties, and we've also got lots of contracted rental growth in our leases. We've always been comfortable with being pretty much 1x covered on the dividend. We're also in the business of buying quite big assets, so retaining earnings to reinvest is not really something that adds a lot of value, because in UK supermarket world, a supermarket costs about £40 million, and our dividends about £76 million. So retaining like 10% of it doesn't really move the needle in terms of reinvestment. So we always had a strategy of investing at around 100%. We've occasionally been a bit uncovered where we've either recycled capital or we've raised money and we've invested it and it just hasn't started earning yet. But it's always been the dividend's always been covered on a kind of a 1 year forward basis, because again we've got that predictability of once you buy the asset, it's going to generate the income, so you can pay the dividend.
And Tom?
Yeah, I mean, my approach really here is to say that we are hardwired to look for companies that actually generate lots of cash. So the starting point isn't how are we going to magic up enough cash to pay for this dividend, and therefore that feeling of pressure that maybe we have to pay out of capital. Because of the investment process being wired to look for those companies with lots of cash, that helps, because really in any given year, we are likely to be generating quite a lot of cash from, give you an example, this year, the big banks are, forgive the pun, but they are cash machines, really. They really are, because of higher for longer. It's the flip side of what Ben was talking about earlier in terms of the cost of debt, that they're obviously their asset margins, what they charge for their mortgages and so on, that SME loans is very, very high. What they're paying, although you see the odd offer on term deposit accounts, really the bulk of their deposits are current accounts. So they've got this huge spread, and they're putting a lot in gilts as well at sort of 4.5% at the moment. So sectors like banks, it will vary from year to year where the cash flow is coming from, but this year, it looks like banks are going to be prodigious cash flow generation, and so really that's how I think it's focus on the revenue account, get to the right number. We've had a couple of specials in the last month. Actually, we had oil company called Ithaca Energy just paying a special last week. We had Peters Hill Partners, which is a Goldman Sachs private markets business. They paid a big special. In fact, they paid 2 specials in the last 3 months. So that's all helpful as well.
David?
Yeah, I mean, I think it's absolutely important. And in fact, since one of the first things I looked to do when I took the fund over was to actually get back to being dividend covered, because we had paid a little bit out of reserves. And I think it's, again, the message to our shareholders is it will deliver you a high level of income that's sustainable but can grow into the future. And I think that's a very difficult message to put out if you're actually paying out your reserves. So the whole point is you generate enough income to be able to pay shares and rebuild reserves is where we are now. So I think it's absolutely crucial.
And I was going to ask, actually, obviously, the ability to build up a revenue reserve is one of the key attractions for me, I think, of the whole structure. And it was very useful when we had COVID and all sorts of problems. So for each of you, can you just sort of give us an idea of how big your revenue reserve is relative to the dividend, and how? Well, I know it's not down to you; it's down to the boards to set the level of the dividend. But how often you think it's likely you dip into reserves? Is that a very rare thing, or is it over a cycle?
Yeah. So I go for yeah. Okay. So I mean, yeah, we're running at 10 months at the moment. So we've got at the beginning of the financial year, let's say none of our companies paid a single dividend for the entire year, we would be able to pay sort of 10 months out. Now, obviously, in practice, you wouldn't want to be running it that tight, but that gives some reassurance. And what we tend to find is that when there's a boom year, that will rebuild, and we'll be heading back to sort of 12 months. We did have a couple of years during COVID where we had to deplete that somewhat. I think we were running at around about 12. We probably came down to about 10 during COVID. We had 2 years where we were uncovered. But I think, you know, that's the beauty of the closed end. So in a way, you know, I know a lot of people at the moment are facing, you know, significant cost of living pressures. When we speak to shareholders, you know, it's quite an interesting divide between some shareholders. I would say a minority of shareholders, you know, talk about capital growth, NAV growth, but the majority, you know, at the typical AGM are saying, look, please carry on covering a dividend, delivering that cash because we've got cost of living pressures we're facing. And, you know, we're hearing specific stories along those lines, which actually give you that sense of purpose.
And Ben?
Yeah, it's interesting because Supermarket Income REIT is effectively a real estate company that we manage. We don't really think about it in reserves terms. We think about it more in terms of sort of available liquidity. And so we've always got 12 months of liquidity available through our banking lines, and that's a sort of critical part of our credit rating as well. Actually, is having that liquidity available. And as I say, it's sort of quite hard to foresee circumstances where we would have a liquidity issue on the income side because of the strength of the cash flows that we're receiving from our tenants. And as I said, during COVID, we had 100% rent collection. I think it was one of the big attractions of the stock at that time.
And how about CT UK, David?
To be honest with you, which might show you how we think about it, particularly, I actually don't know what the cover is at the moment. I'd have to check the absolute number. As again, be more thinking about rebuilding than what it is. But it's something that is there, I believe, for extreme environments like COVID. It's not something we should be doing as a matter of course, and therefore you probably shouldn't build up too much either. So it's important, but it's in the background. As I said, the fact I don't know off the top of my head shows you how we think about it, really.
Fair enough. Now, one of the things that Tom was talking about was the cost of living, and that's definitely a big thing for investors. So how important do you think it is, again, maybe not every year, but again, over a cycle perhaps, to try and grow the income in line with or ahead of inflation? And maybe, do you want to take that first, David?
I think clearly it's very important. If the aim is you want your shareholders to be able to hold the company, knowing that they get dividend, and knowing that income has the same value to them in the future, then it has to go with inflation. That has been hard in the last few years, not least because inflation's been so high, and we know that's had challenges for companies as well as benefits in some cases. But it's certainly something we will look to do over the long run. I think that's important. I don't think we will always be able to keep up with inflation in periods when it spikes for a year or two, as we've just had. But I think we grew at just under 2% last year. I can't say what we'll do this coming year because obviously that is a decision of the board. I'm always frustrated when companies tell me that, but that is the reality of things. So yeah, it's crucial to try that. I think it's really important for shareholders.
You agree, Tom?
Yeah, we've grown the dividend every year now, 24 years, as I said at the beginning. It is a very unusual situation. RPI, I'm just having a look at the data now. Annualized 5-year RPI growth came in at 6% in the 12 months to September 2024. Just put a number on it. Previous year, it was at 5.9%. The year before that, it was 4.8%. So if you look at the individual years, I mean, obviously RPI has come down quite aggressively post the spike linked to Russia, Ukraine. But the average, you know, how many income funds or trusts have managed to keep up with that kind of level of growth? I would say not very many. Yeah. And so, you know, that's been a headwind. I see it as actually, let's think about which sectors and stocks are actually benefiting from that environment. So best way to, rather than sticking your head in the sand, is actually say, look, there will be people who are making hay in a higher inflation environment. Make sure you're backing those stocks and sectors.
Now, Ben's got an advantage because your rents are index linked.
Yeah, a lot of them are index linked. Most of them are capped at either 4 or 5% though. So we have a similar issue in terms of trying to keep up with very high RPI. And then the sort of the headwind that we've had is increasing debt costs on the other side of the equation, and the P&L. So, you know, we do aim to increase the dividend every year. You know, we would like to increase it by inflation. That's not been possible for the last couple of years because of the increasing debt costs, but it's certainly the aspiration on our side, and it's, you know, that dividend growth and earnings growth is really important to the shareholders in supermarket income REIT. So something we're laser focused on.
Yeah, I think it's important that investors recognise that it's not going to be possible for most funds to be able to do that year on year to beat inflation, but you'd hope so, like catch up over time. Yeah, cool. And you mentioned debt costs. So can you sort of talk us through what happened with supermarket income REIT in the environment of rising rents, please, or rising interest rates, please?
Yeah, absolutely. So yeah, I think we kind of went from a environment, I guess, three and a half years ago, where our cost of debt was probably about 2%. And you know, that was obviously a very attractive environment to be buying assets that were yielding 5%. So that was where we were. You know, I think our view now is that the marginal cost of debt for supermarket income REIT, so supermarket income REIT wanted to borrow new money for 5 years in sterling, it'd be more like 6%. So we've adjusted to sort of 4% increase in the cost of debt. Now, we put in place interest rate hedging for that interim period, which has provided some protection to supermarket income REIT's balance sheet, and that means that that cost of debt has actually increased kind of gradually over the period, rather than being a sort of one-off upfront hit. And the impact of that is that really the kind of the contracted rental increases that we have coming through on our leases broadly offset that gradual increase in debt costs. So we feel very comfortable about the sustainability of the dividend in the new higher interest rate world, and we're certainly not, you know, wishful thinkers and thinking that interest rates are going to go back down to the kind of levels they were. We're positioning supermarket income REIT to survive and thrive in the new environment, and we certainly believe that it can do that.
Great, thank you. Right, we've got lots of questions from the viewers, so let's get to some of these. And let's start with this one here from Sabrina. So, Thomas, what sectors currently offer the best opportunities for reliable income?
Okay, what I'm going to do with that question is, first of all, say some people, when they hear the words reliable income, they will say, here's a beverages stock. But the problem is it will yield 2.5%. So I'm going to take this question to the next level, which is, I think you should be asking for reliable income and a valuation that implies that the stock market doesn't believe it's reliable income, because I think that's the winning formula. So really look, I'm trying to do both the reliable income plus the valuation. And if you get those two things right, you get the dividend yield, you get the dividend growth, and then you get the valuation re-rating, it all comes together. Now, which types of stocks and sectors fit the bill? Well, it will vary through the market cycle. I've already mentioned, you know, Imperial Brands is a good example of a stock where, look, it's been written off. This is a tobacco firm, been written off. The shares were trading about £12-13 as recently as 2021. They have doubled since then. Now, how has that happened? Well, that's because the market had written off that entire sector. The dividend has grown quite mechanically. They've done a buyback. So they're actually handing out, in pounds terms, they're handing back £2.5 billion a year, half dividends, half buybacks. And that's a kind of low to mid-teens percentage of their market cap. So that's pretty huge. So I'd say, look, first thing to say is, if you had done a straw poll 2 years ago when the shares were half the level, if you want reliable income, do you buy Diageo or do you buy Imperial Brands? I would guess, I don't know about you, James, 8 out of 10 people would say Diageo, 9 out of 10 maybe. So look, first thing to say is keep the faith on valuation. If you find stocks that are mispriced, back them if you've got that conviction. Look, at the moment, the other ones I'm really keen on at the moment is sort of construction firms. So we've got Galliford Try, which is demerged from Vistry. We've got Balfour Beatty. In the environment of slow economic growth, governments all around the world are going to have to do some investment in infrastructure. So I think that's a banker as well. They're cheap stocks as well, those ones.
Brilliant, thank you. Next question down here is for David. So what do you think on the relative attractiveness of the UK as a market for investing for income as opposed to other global opportunities?
Well, I mean, I'll build, I think, probably some of the points Thomas has made in that, think about valuation. The UK, by pretty much any measure you want to think about, it is one of the cheapest, if not the cheapest, developed market anywhere. One of those methods of valuation, which is particularly pertinent for us, is dividend yield. It has the highest yield anywhere. And I think Thomas made this point earlier, the diversity of stocks that you can get that yield from goes all the way from the very bottom to the very top. And I would say in the vast majority of cases, and again, Thomas made this point really, it's not because they're bad businesses, it's because they're out of favour for some reason. And it could just be because they're UK, could be because they're domestic. So I'd put the house builders perhaps in that sort of domestic camp as well that Thomas talked about. Anything exposed to interest rates. So Ben could talk about this for a long time, but any of the REITs look really attractively valued from an income perspective, very high valuation. Life insurance in the UK is a sector which most people, it's just too hard. I don't want to worry about it. Therefore, you get 11% yields on businesses that have incredibly visible business streams. So I think there are many reasons why the UK is attractive. I have my foot in our European camp as well, and the UK looks very attractive relative to Europe, no matter what's going on here. But income, the ability to find durable income that can grow, I think, is an absolutely key point for investing in the UK. Of course, I would say that, wouldn't I? I run a UK income fund, but there we go.
No, fair enough. Brilliant. Ben, just to paraphrase this question slightly. So obviously it's in the name, supermarket income REIT, but why supermarkets and not the broader retail sector?
Yeah, we really like the sort of essentiality of grocery. So, when push comes to shove, people need to eat, and that food needs to be delivered through some form of infrastructure. And so the supermarkets we own are really the food infrastructure for the UK. We also really like the way that online interacts with supermarket real estate. So we've seen non-food retail be really heavily impacted by the growth of the internet. So if you think about shopping centres and retail parks, they've gone through a really tough time. There's a lot of what they sold moved online and went straight to your front door. I mean, grocery, it's very different because actually the predominant model for grocery home delivery is to use the store as the last mile delivery depot. So 80% of online grocery orders in the UK are delivered from a store. They don't come from a central warehouse. So that's another part of the durability of the assets. And it really is practically impossible to replicate these sites because they're very big. They're sort of 10, 12 acres, surrounded by houses, next to roads. They're going to benefit from growth in online shopping. They allow customers to go and shop in person still, which actually lots of people like to do. And everybody needs to eat. There's a growing population. We're going to see increased volumes of groceries going through them. So that's why we really, really like it as a sector.
Makes sense. Thank you. For Tom and David, what do you think about the yields that are available in renewables and infrastructure? Because they are quite chunky. Maybe start with David.
Okay. We don't have much exposure. I mean, I think interesting your news point at the beginning that you talked to this very theme, and it's very difficult. It's still relatively nascent. There's problems in pricing, there's problems in access, there's problems in durability of equipment. So it's not something that we really have exposure to. One thing we do have is SSE, which is the UK's largest wind farm operating, and will become even bigger when the pipeline is developed. So it's interesting. Not something we played out particularly, I think, at this point.
And I would add to that, as well as the utilities, I would also look at Drax, which is a generation company, obviously known for the power plant in North Yorkshire, which is a biomass plant, which gets a few headlines. If you think about the last 2 to 3 weeks, what's happened is wind speeds have been very, very low, and at the same time, there hasn't been much sun. So renewables generation has ground to a halt. Now, obviously, you talked about Harmony at the beginning, energy storage there, James. I mean, that's when the UK really needed storage in the last 2 to 3 weeks, but the technology just isn't there yet. And I think, for me, actually, for all the bad headlines that Drax gets, if you have a look at the percentage of power generation from that one plant in North Yorkshire, it's about 4 or 5% of the UK's energy needs, which is incredibly important. It's the release valve when the wind isn't blowing. They've also got hydro, so they've got pumped storage called Kraken. Obviously what, you know, I met them a couple of days ago. What's really interesting is they were talking about the sort of variability in price being something that they really enjoy, because if you think about, you know, they take out hedges, so it's a bit like the banks taking out or buying, using what they call the hedge book, so buying gilts when yields are very, very high. They're able to hedge out their energy prices at the highs, and of course, you know, we do need Drax, so I think that one's worth a look.
Okay, thank you. Now, all three of you, I think, the sort of net revenue income question has got two sides to it. So obviously the income you're generating, but there's also your expenses against that. So can you each sort of talk about what the running costs are of the fund and how they've been trending, please? And let's start with Ben.
Yeah, we've sort of been in the headlines a bit more recently on this one. So yeah, so we have a very simple structure. So Supermarket Income REIT has an independent board of directors, and we're the external investment advisor to Super. And at the moment, it's a very simple structure where there's a sort of a fee scale that's based on the net asset value of the fund. And we've just announced that we're going to move that to the market capitalization of Super rather than the net asset value. And what does that do? It means that actually, at the moment, we're trading at about a 20% discount. So it's roughly a 20% reduction in fees, which, along with a few other things we're doing, is going to pass through about a £2 million per annum saving to Supermarket Income REIT shareholders. You know, why do we think that's important? It's slightly ironic, actually, that when we were doing the pre-soundings before the IPO for Supermarket Income REIT in 2017, we actually thought that the fees should be based on market capitalization because of the alignment that creates between us advising the company and the shareholders. And we were sort of told by everyone, no, it's all, you know, just do it on NAV because that's what everybody does. So there's been a lot of pressure recently because of the discount to move to market capitalization. And it's, you know, given that was our initial conviction, it's quite hard to argue with, really. You know, it's a much better alignment of our interests and the shareholders' interests for us to both be looking at, you know, the same number that matters, which is really the share price. And that's what we're, you know, the dividend is clearly really important, but I think what we believe is that if we can drive earnings and dividend growth, then that's going to drive share price appreciation, and, you know, we should be rewarded in line with the shareholders for that, rather than having some slightly abstract NAV figure, which is really just the opinion of a valuer, rather than a number that the market is actually saying they think the company's worth. So we think it's the right way to do it, and that's what we've just announced.
Great, thank you. I agree with all of that. David?
I guess the first point, of course, is that the dividend is post all the costs anyway. So that's the bit we're really focusing on, to make sure we can deliver that and grow that. It's a bit of a sort of, I guess, a cop-out answer, but it's something we think about much more in conjunction with the board. In this case, that obviously that's really much their focus. My focus particularly is on delivering the return to make sure we cover those costs. But yeah, it's something the board are very conscious of. we spend a lot of time, and they spend a lot of time talking about to deliver best returns. But the way we think about it is to make sure we can deliver that dividend and grow going forward.
And I would, add to that if you look on the latest fact sheet, you can see the annual management fee is 0.55% on Aberdeen Equity Income Trust. There are ongoing charges as well on top of that, so they typically add sort of 0.3, 0.4. And look, I mean, it's under constant review, and as you'd expect, we are held to account, and the board do a great job of holding feet to the fire. There's been a bit of downward pressure on management fees across the whole industry. We are no exception, and it's on me to deliver and justify active fees for active management. And I do think high active share for me, it's sort of we're in the high 70s. It's important to do that. It's important to be showing that look, we are different from the wider market, and that we are going to justify our active fees.
Fair enough. I mean, the question here is actually about comparing you with one of the biggest funds in the sector. I think we should also stress that these percentage running costs are a factor of size to some extent, because obviously all sorts of things from board salaries to cost of orders and everything else, they all proportionally come down as you get bigger and bigger. So if we can make these funds bigger, then the fees will come down. Couple of stock specific questions actually, which we've got time for, I think. So David first, what's the attraction of BT?
It's really interesting because actually I've only recently bought BT for the first time in many years, to be honest. And the problem we have had with telecoms generally is that it seems to be a negative sum gain for a long period of time. That's particularly true in mobile, where it's always been easier for someone else to launch an MVNO where it's a virtual network. You piggyback, you have no infrastructure costs, and it's all about your cost of customer acquisition. If you get beyond that, it's relatively easy to have a lower price. And then you have spectrum costs, and you've obviously had years and years of action by regulators. So that's the backdrop. I think now, if you look forward, and BT themselves have been spending an enormous amount of money on fibre rollout, which is absolutely called for and required, but it means there's years and years of spending a lot of money. And you add on top of that the pension fund. So BT was often described as a large pension fund with a small telecoms company attached. Interest rates have helped that quite a lot, and they've put a lot of money into the pension scheme. So now the situation whereby, looking forward, we can see in the visible horizon the peak of this capex on fibre. Once that happens, simplicity, they're spending less cash, but more importantly, the cost to service that network compared to the old copper just drops dramatically. So cash spend drops, costs of maintenance and service and keep the network going drop as well. So we can see a big delta in cash flow generation coming in the next 2 or 3 years. At the same time, we think that the newish now chief exec, she was in the offices last week, I think, really gets how to deliver that message. It's always been there. I think the message has been delivered very well. Now we think it's really coming through, and we're being paid an attractive dividend yield over 5% while we wait. So we think it's a really positive momentum behind the business rather than shares. That seems to be coming as well. So yeah, first time I ended a very long time. I'm really excited actually.
Cool, brilliant, thank you. And Tom, the stock that's been singing out for you here is Balfour BT.
Yeah. I mean, I think this one, again, a great thing is the corporate access that we have. We've met them twice in the last 3 months. They've just trading their stocks off for a start. So look, first point to say is, in a macro which is this unstable, with everything that's going on in the world, finding a business that's actually got an order book that's backed up by the longevity, with power contracts in particular, specialist niche. To your earlier point about infrastructure is, this is the picks and the shovels, quite literally. That the likes of SSE and National Grid have got a huge amount of capex to roll out. Guess what? Balfour BT is the key contractor. And if you look at their infrastructure book, it's about half of the market cap is infrastructure. So, again, if you want believability of this share price in terms of how wrong can we be on a stock whose market cap is half already in the books at conservative valuations, because every time they sell something, there seems to be an uplift on the carrying value. So look, I think it's set fair both in terms of trading, valuation's cheap. There's lots of dividend growth coming on this one, I think. So it's not such a high yield stock, but it's a very good dividend growth stock.
Brilliant, thank you. I think we're running out of time. So one last question for all of you, just on the discounts. Can you just talk a little bit about what, if anything, has been going on to try and narrow the discounts on your fund? Actually, I know one of you doesn't really have much of one, but maybe let's start with Ben, please.
Yeah, it's we're very focused on that. So clearly, the number one thing is to drive some dividend growth, because I think people are very focused on the headline yield. So to the extent we drive dividend growth, I think that drives share price and starts to narrow that discount. We are actively looking at recycling some of our assets. We've got some assets on the books that we would say are kind of dry, probably yield 5-ish at the moment, and we can sell maybe some of those and recycle into high yielding assets, which will not only drive dividend growth, it'll also prove out the valuations. We're exploring the potential to JV on some assets that maybe the market views as a bit riskier. We actually really like the assets, so we don't want to part with them 100%. But again, if we can do that with somebody very credible, it will prove the valuations, it will prove our underwriting, and again, that should bring some more capital that we can recycle. That's kind of the asset side of the business, and then clearly the other piece, which is really important, is just getting the message out and marketing the business to investors. So just being down in South Africa, we're just about to get a secondary listing on the JSE. We think that could bring significantly more liquidity into the stock. And we'll always have a team of people on the road out there getting the message out of the quality and sustainability of our earnings and our portfolio. Great,
thank you. And David?
Yeah, it's something clearly that the board are very focused on. We talk about it in most meetings. It's about 10% in the ordinaries, a little bit more on the Bs, which are smaller. Share buybacks are something we think about. It's not something we want to do. We don't necessarily think it's the best use of capital. To be honest, it's a pretty small trust as well, so that doesn't necessarily help existing shareholders for liquidity. Of course, the benefit of a bit of a discount is the actual yield is higher than it would otherwise be. So we think there are some payback there as well for shareholders and for potential new shareholders. So no active plans, something we focus on a lot. Clearly, it's a topic it's talked about an awful lot.
Brilliant, thank you. And then Tom, I think your chart is actually a sub-5 discount. Is that right?
Yeah, that is correct. Yes. Look, we've done some research into what drives discounts and premiums, and I think in the income sector, I think the two things you've got to show is believability that dividend is sustainable, and I think we've done that. We've shown that even through really tough times, we can pay this dividend, we can keep it growing. I think the other thing to say is performance, NAV growth, and sort of recovery potential is important. And I think that's been more challenging. Actually, if you go all the way back to sort of 2018, 2019, when bond yields collapsed at that point, income funds really fell out of favor because, basically the simple maths was the DCF of a tech stock went through the roof because you've got all the value tied up in the final 2 or 3 years of that company. DCF model, that goes through the roof because discount rates fall. Ergo, why would you bother with income funds? And I think that was a really tough period. So I actually look at the current environment with people now opening their minds to higher yield stocks. So it's not impossible. And in fact, we're showing, with people like Imperial Brands, if we do that, we can replicate that, performance of the NAV performance will pick up. And so the two things, I think, dividend growth and NAV performance can drive that tightening discount. And actually, we've had a period in 2023 when we were issuing shares, not just a few days. That was over a relatively prolonged period, 6-9 months, when we were issuing shares. It is possible. There are other income trusts out there that are issuing, so we're looking to deliver that, improved consistency in NAV performance and earn the right to issue shares.
Brilliant. Thank you very much. Well, I hope you all end up doing that. But thank you very much for your time today. It's been really interesting, I think, and we will follow how you get on and talk to you again soon, I hope. But thank you.
Thanks, James. Thank everyone for your time. Bye-bye.
So let's come back. Now I will, hang on. That's where we go. Sorry. So thank you very much for looking at tuning into the panel, and we'll have that video up on the screen after this. But the next part of the proceedings is to announce the winners of our Investors' Choice Awards. So thank you very much indeed for everybody that got involved with this. As you'll know, there were 12 awards that we were going to give out, and they're there on the screen. So I've got the winners there. Before we go into them, though, I just want to thank Cazenove Capital and Stone Age Fleming for sponsoring it. That made all the difference in the world in terms of getting the message out. And two of the representatives there were part of our 5 judges that took a huge amount of data from 5-year performance data that we generated, and then sifted that down to get the nominees in each category. So thank you very much indeed for them. They're there on the screen there. And from that, we pulled together 38 nominees. Shaker India actually got nominated twice for 2 different categories, but that was all part of the plan. And so those 38 names completely independent from us, and I'm done by that panel. But nevertheless, I think all of them need to be congratulated, really, in that they all sort of merited being nominated. And then we asked the individual readers of our research and the sort of ordinary investing public to choose the winners. And this is the thing that we wanted to do, because we thought it's important to kind of get the views of these people to actually really have a genuine view of like who your favorite fund is. So without further ado, so the best for long-term capital growth, we had nominees of Harbourvest, Oakley, HG Capital, and the Shaker India. And the winner here, it says it's hard not to include the top performing private equity trusts over the last 5 years. Their NAV growth has been vindicated by the prices it achieves and realizations, and has also been reflected in the recovery in its share price. And so the winner is, HG Capital Trust. And then for income, oh, there we are, I've already clicked too soon. Lord Debenture. They were the favourite from choice of Alliance Trust, BBGI, Global Infrastructure, Greencoat UK Wind, and Lord Debenture. And the attraction here was that they used the strength of the capital structure. They've got a separate business that earns income, and then that supplements their income and allows them to have a sort of wider proportion group of stocks within the portfolio, and that's worked out for them quite well recently. And then global exposure, we've got the nominees of JP Morgan Global Growth and Income, AVI Global, F&C, and Caledonia. And with regards to the winner here, the judge has said this trust has been a fantastic story. So after its management refresh in 2017, it's become a more dynamic strategy. I'd be adapting to a global equity market better than any other global trust, ranking top in 5-year NAV returns. This came alongside its 4% dividend, paid in part from capital, which they said is a good use of the trust structure. And obviously, our panelists might disagree with that. And its ability to grow its market cap via mergers and new share issuance. And the winner is JP Morgan Local Growth and Income. For UK, the nominees were Fidelity Special Values, Rockwood Strategic, Edison, and Aberforth Smallers. And with regard to the winner here, so the inclusion of sort of 5-year NAV returns being magnitudes ahead of its peers, and the returns reflect its private equity approach to listed equity investing, one that results in an in-depth understanding of each company and results in a high conviction portfolio of a handful of UK small caps. And the winner there, Rockwood Strategic. Next up is the country region exposure. And the nominees here were Ashoka India, Fidelity European smaller companies, and Vietnam Holding. And with the winner here, it represents the top performer in what's been a strong region. Its investment process has allowed it to consistently generate outperformance while successfully navigating the volatility of its local equity market. And the winner was Ashoka India. And for specialist equity, the nominees were Allianz Technology, Polycap Healthcare, BH Macro, and Herald. And this trust delivered some very impressive returns over the last 5 years, helped by a focus on the star sector. The winner is Allianz Technology. For alternative assets, the nominees were Tufton Oceanic Assets, Renewables Infrastructure, Pantheon International, and 3i Infrastructure. And the judges said of the winner, they're one of the best examples of its sector, run by a well-resourced team that has produced a high-quality and well-diversified portfolio, a pedigree that's been reflected in its NAV returns. And the winner is 3i Infrastructure. And then property. So the nominees were AEW UK REIT, TR Property Investment Trust, Urban Logistics, and Impact Healthcare, now called Care REIT. And nominating the winner, the judges said the inclusion of this trust reflects it being one of the best one-stop shop options for diverse real estate exposure. And the winner was TR Property. And then we're looking at the best asset managers. So we have large asset managers, anything with 5 funds or more, or best boutique, which is 5 funds or less. So 4 funds or less. And the nominees for best large asset manager, who are just 3 of them, the JP Morgan, Aberdeen, and Janus Henderson. And what we asked the voting public to take into account was not just performance of the funds, but also how well you felt they did in terms of their quality of communications in the service that they provided to you. And the winner for best large asset manager was JP Morgan Asset Management, and for best boutique, where the nominees were Infrared Capital Partners, Harwood Capital, Asset Value Investors, and White Oak Capital Management. The winner was Asset Value Investors. Now, the last 2 were not things that were voted on by the public, but they were just decided by the 5 judges. So the best board, the winner of this has actually done a great job of trying to tackle what was quite a wide discount. Hasn't got there yet in terms of closing it down, but they have made quite a lot of headway. They announced one of the largest buybacks last year, and then they followed up with a sort of capital program that sort of is designed to gradually drive the discount down. And they're also trying to do a lot more in terms of marketing and trying to highlight the attractions of the sector. So that best board goes to Pantheon International. And then finally, we wanted to pick a person of the year. And this person is chairman of a few funds. Well, a couple of funds have been taken over. So firstly, actually, it's pretty easy to tell you who you are there. And then leading to it. So the person of the year is Robert Naylor. So he was the chairman of Rand Hill Music when it got bid for, and he managed to extract a decent price for that. And then when Hypnosis Songs got into trouble, and the shareholders were disenchanted with the existing board, they felt that Robert actually might be a sensible person to bring in to help steer the direction of that fund. So he was parachuted as chairman of Hypnosis Songs Fund, and managed to secure a decent bid for that trust too. And then again, more recently, with a group of shareholders got very upset with the board of PRS REIT when they tried to extend the management contract and without sort of shareholder approval. So he's been parachuted in there and is busily trying to sort that out. So that's the reason I think that the judges selected Robert Naylor as their person of the year. So with all of this, we said if you vote and you predict the winners, there is a £5,000 prize available. And we were very pleased yesterday to present that to Samir Lee. There's a picture of Ed there, smiling, giving away money, which is unusual. We're very pleased to do that, and we're hoping to do that again next year. So thank you very much indeed for tuning today. Next week we'll be talking to David Smith from Henderson High Income, and then we've got Craig Baker back on talking about Alliance Return on the 13th. Then we'll have a break for Christmas, and then I will be back talking with Angela Hattie about the events of 2024 on the 3rd of January. So have a very good weekend, one and all, and I will see you next week. Thank you very much.